Welcome back to the deep dive. You know the drill. We take a stack of sophisticated source material, pull out the essential nuggets, and give you the fast track to market competency. Today, we're diving deep into financial market precision. Our sources come from some advanced educational platforms, specifically Bell's Forex and Systematica.
And these are dedicated to pushing traders past the basics.
Right. We're not talking about beginner tips here. We are tracking the demanding and, well, often costly journey from that foundational knowledge.
The ultimate trading guide kind of stuff.
Exactly. All the way up to the mastery required to implement systematic automated strategies.
And the mission is clear: to equip you with a structured framework. This isn't about gut feelings or intuition. It's about moving beyond emotional bias.
It's about discipline.
It's about discipline and data. If you want any kind of consistency, you need systematic precision. And that's really what our sources are here to define.
Okay, so let's unpack this. The journey we're charting is really how precision gets built. It's a continuum, starting with the micro-analysis of human sentiment you can see in a single candlestick, and ending with, high-speed, institution-grade automated algorithms.
That whole transition from just spotting a pattern to actually coding a system, that's what defines expertise today.
So let's start with that philosophical foundation. Systematic trading. Systematica, one of the platforms, defines it as bringing discipline and precision into trading.
Through clearly defined, data-driven strategies, it's a huge shift in mindset.
It really is.
It is. The core goal here is consistency. Discretionary trading relies on your real-time judgment, on emotion, and that just introduces so much variance.
Right.
Systematic trading, it eliminates that emotional bias. It reduces every decision to a binary input. You either follow the rule or you don't.
So you're making smarter decisions grounded in stats for long-term survival.
Exactly.
I think a lot of people hear systematic and they just jump straight to automated, but the sources really emphasize that the philosophy has to come first.
Oh, absolutely. It's the whole process of finding your edge, your specific edge, and then codifying it.
And because that success depends so much on custom precision, these platforms offer very specialized services.
They do. They move way beyond just generic advice to help traders define and then implement strategies that are tailored, exactly to their capital, their market access, their risk tolerance.
And here's where it gets really interesting. This is where we see the rubber meet the road in terms of commitment.
You mean the price?
I mean the price. Systematica's offering, it includes automated trading systems, advanced research. But to get that really personalized help,
the one-on-one stuff,
the one-on-one monthly consultations, the dedicated system development, you're looking at a pretty substantial investment. Their extended plan is nearly €1,000 a month.
Well, and that price tag, it reflects the complexity of translating human insight into reliable machine code. It's not just about buying a piece of software.
No.
You're paying for the service of having an expert sit down and dissect your strategy, which might even be successful but inconsistent, and turn it into something robust, something back-testable and repeatable.
So they're not just giving you tools, they're helping you engineer a whole methodology.
That's it. So if you're a trader, the investment isn't just about efficiency, it's about minimizing the single biggest risk factor in your trading.
Yourself.
It's about buying back your time and your emotional consistency by outsourcing all that repetitive decision-making to a system that you trust, because you help design the rules.
That's the payoff. It lets you focus on the high-level strategy, the research, instead of fighting that urge to panic sell during a volatile minute.
Right. So systematic mastery is really just mastery over your own psychology, but achieved through rigorous data.
Okay, so that systematic mindset needs inputs. And a lot of the time, those inputs start with the most basic form of market data, the chart. So now we swing from that high-level philosophy right down to the ground level of technical analysis. Candlestick patterns.
Candlesticks are the visual language of market psychology. They quickly summarize 4 key data points: the open, high, low, and close.
Over a specific period.
Right. And by looking at the size, the color, the length of the wicks, you're essentially reading the battle between buyers and sellers.
And that can signal trends, reversals, or just plain old indecision.
The sources categorize them pretty neatly. You have reversal patterns, which signal a trend might be ending, and continuation patterns, which suggest the momentum is going to hold.
Let's focus on the heavy hitters, the ones that just scream a major shift in psychology.
Okay, so take the engulfing patterns. These are really powerful reversal signals.
Right, so in a downtrend, you're on the lookout for a bullish engulfing pattern.
Which is when a small red or bearish candle is followed by a much larger green bullish candle that just completely overwhelms the previous one.
It's a visual sign that the sellers who are in control have just been totally crushed by new buyers flooding in.
And the opposite is true for the bearish engulfing. You're in an uptrend, you see a massive red candle just swallow the previous smaller green one.
That's a huge warning sign.
A very clear sign that distribution is happening and sentiment is collapsing fast.
Then you have those great three-candle structures like the evening star.
It's a great name. The evening star signals a reversal at the top of an uptrend. So it's made of three candles, a large bullish one, then a small indecisive one, the star, and then a third large bearish candle.
That middle star is like the market taking a pause.
It's exactly that. It's a point where buyers tried to push higher, they failed, and then the sellers took decisive control.
We also see the momentum patterns, the 3 white soldiers and 3 black crows. These are not subtle at all.
Not in the slightest. 3 white soldiers are 3 consecutive long bullish candles. It just indicates robust buying pressure, a really decisive shift.
It's like the market is shouting, we're not pulling back, this momentum is real.
Yeah, and the source material notes, these old military-inspired names actually help traders remember the structure and the power behind the move.
But, and this is a huge but, the crucial lesson from the sources is that candlesticks are just observations. Relying on them alone is just gambling.
Exactly. Systematic trading requires confirmation.
You have to combine that visual analysis with mathematical tools. This is where the discipline really kicks in.
Absolutely. You need confirmation tools like moving averages to get the bigger trend context, Fibonacci retracement levels, and of course the relative strength index, the RSI.
Okay, let's touch on those. What's the psychology behind using Fibonacci?
Well, the Fibonacci ratio is 38.2%, 50%, 61.8%. They're often seen as these natural psychological support or resistance levels.
So traders believe prices will pull back to one of these levels before continuing.
That's the theory. Use the ratio not as a magic predictor, but as a high probability entry point that complements the visual pattern you're already seeing.
And the RSI, that's all about checking for market exhaustion, right?
That's its primary job. The RSI tells you if an asset has been overbought, pushed up too far, too fast, or oversold.
So if you spot a bullish engulfing pattern, and the RSI is also showing it's deeply oversold.
Now you have 2 independent data points that are both confirming a high probability for a bounce.
Which brings us to that discipline process, the one demonstrated by the hypothetical trader Alex in the source material. Alex doesn't just see a bearish engulfing and immediately short the market.
No, absolutely not. Alex identifies the pattern, but then waits. Waits to see if the price is retraced to, say, a 61.8% Fibonacci level.
Okay.
If it confirms both of those, and the RSI shows the asset is overbought, then the probability is maximized. Then and only then does Alex enter the trade.
And always with a strictly calculated stop-loss order placed immediately to manage the risk.
It's a 3-step systematic checklist. It has to happen before any execution.
We've established the need for systematic rules for sophisticated analysis. But when you're managing massive institutional capital, human speed is just not enough. So we have to transition to the technology that executes these strategies with split-second precision execution algorithms.
This is a high-tech component. And it's important to remember these algorithms aren't trading strategies themselves. They are tools for execution.
Right.
If a fund manager wants to buy, say, 1 million shares of a stock, dumping that whole order on the market at once would instantly move the price against them. That's called market impact.
And what's so fascinating is that these algorithms exist specifically to prevent that slippage. They split those massive orders into thousands of tiny pieces.
And feed them into the market strategically, under the radar.
Exactly. And the choice of algorithm depends entirely on what the institution is trying to achieve.
Right. Is their priority to minimize market impact? Is it time, or is it just raw speed above all else?
Let's run through the core types. We can start with the 2 classics, VWAP and TWAP.
Sure. VWAP stands for volume-weighted average price. So if a fund manager wants to buy that 1 million shares, the VWAP algo will look at the stock's historical trading volume and execute its little pieces in line with that volume profile.
So the goal is to get an average price that's really close to the market's average for the day. It's like stealth blending.
That's a great way to put it. And TWAP time weighted average price, that just prioritizes even spacing.
Okay, so TWAP is simpler.
Much simpler. It just executes orders evenly across a set time. 10,000 shares every 5 minutes for an hour. It prioritizes time over volume. VWAP is volume focused. TWAP is time focused.
Okay, moving up in complexity, we get to the algorithms that are all about competitive speed, like implementation shortfall. Or
Implementation shortfall is all about minimizing the cost of delay. The shortfall is the difference between the price when the manager decided to trade and the average price they actually got.
So it's all about speed to lock in that price.
It's programmed to execute as quickly as possible. You see it used a lot in volatile markets or right after big news breaks. It's the algorithm that wants to win the race to the terminal.
Then you have the router smart order routing, or SOR. Because the market is so fragmented now, split between all these different exchanges and dark pools.
SOR is the navigator. It instantly evaluates which venue has the best price, the best speed, the best liquidity for that one little slice of the order, and it routes it there immediately.
Making sure you always get the best possible fill.
In a super complex market landscape, yeah.
And finally, the one algorithm that I think fundamentally changes how you have to perceive the market. Iceberg orders.
Iceberg orders are crucial for understanding institutional deception. And I mean that in a purely strategic sense.
Okay.
A trader looking to execute an order for 1 million shares might only show 50,000 to the public market at any one time.
That 50,000 is the tip of the iceberg.
Exactly. Once that little piece is filled, the algorithm automatically refreshes the order with the next 50,000 shares. And it keeps doing that until the full million is done.
That ability to conceal your real intent is massive. It basically means what you see on the order book is often a lie, a strategic misdirection.
Absolutely. So the benefits of all these algos are clear. Less slippage, minimal market impact, better efficiency. But there are serious challenges too.
Latency, for one. A millisecond delay can be the difference between a good fill and a bad one. But what's the biggest analytical risk?
Overfitting, that's the big one. An algorithm can be designed and back-tested against historical data, and it performs beautifully in all the simulations.
But the real world is different.
Right. If market conditions change even slightly, say volatility shifts, that hyper-optimized algorithm can just fail dramatically in the real world. You've basically built a perfect machine for a market that doesn't exist anymore.
So what does this all mean for the ambitious learner today? I mean, we started with the necessity of systematic discipline. Then we moved through the sophisticated human analysis of charts, candlesticks, Fibonacci RSI, and then finished with the institutional precision of these execution algorithms.
It really confirms that market competency is a three-tiered structure. You have to have that disciplined, systematic framework. You have to incorporate sophisticated technical analysis to find real opportunities. And finally, you have to be aware that the biggest players are using automated precision to handle the operational side.
So knowledge isn't just power here, it's a prerequisite for survival.
It is, and that focus on consistency and discipline has to come first. Without it, the best system or the best chart pattern in the world is, well, meaningless.
And we need to make sure you anchor this in risk awareness. Our sources are very, very clear on this.
They are. Financial instruments carry a significant risk of capital loss. Market volatility can cause really rapid fluctuations. Everything we've discussed today is strictly for educational purposes.
And it should never be considered financial advice, investment recommendations, or any kind of professional guidance.
Please remember that.
All right, as we wrap up, let's leave you with one final provocative thought, linking that institutional world back to the retail mindset.
Okay.
We just discussed Iceberg Orders algorithms designed to intentionally conceal the true size and intent of major institutional trades. So if you know that most of the large volume is being strategically hidden or broken up by automation, how fundamentally should that change the way a disciplined trader interprets what looks like simple, observable daily volume?
What assumptions about market transparency do you have to question when you're just looking at the tape?
That's a good place to pause. Thank you for joining us on this deep dive.
We'll catch you next time.